Is it good to see the US dollar regaining strength?
Well, I think we've had this recent weakening as a result of the Fed comments, but I think the recent statements that have been coming out from the Fed governors seems to be pushing that back in reverse, and the markets aren't liking it very much, especially out here in Asia, where we're very dependent on the weaker dollar, and on commodities as well. We're sort of going back the other way.
It's almost as if they're completely neutralizing what came out of the meeting.
Yes, I think there's a bigger game that may be being played out here. There's a lot of speculation, especially in the press, about what was actually said and done at the G20 meeting, whether there was this grand bargain that was struck and various other things. It is interesting that as the Fed governors are talking up the prospect of a rate hike again, you're seeing the renminbi starting to devalue as well.
They're even equating it to something like the Plaza Accords in the 1980s, aren't they, but done on the QT. But you know, there is perhaps some evidence for it, isn't there, given what's been happening ever since that meeting?
I wouldn't want you to put words in my mouth.
I'm not. It's far be it from me to do that.
I think certainly there is a lot of interesting things that are going on at the moment in the market, and I think the Chinese really don't want to see US interest rate rises, or at least that's the way that they seem to be acting. You remember in August last year, the US was talking about rate hikes in September, and then you saw the renminbi move. What we've been seeing is a very high correlation between risk asset markets, oil, equities, various other things as well, with the renminbi. So that's become front and center of the equity market concern.
If there was some sort of spoken, unspoken accord, is that altogether a bad thing? Because greater central bank cooperation, collaboration, or at least communication, has been what a lot of central bankers have been calling for a long time.
I think the thing is that the way that the objective functions of all these different central banks are working, they're almost going against each other. So if you look at it, you want the Fed and the PBOC want the dollar to be weaker. The BOJ and the ECB want the dollar to be stronger. The question is exactly what is the optimal level for it to be. And some of the work that we've done seems to indicate that the dollar would actually need to be a bit stronger. The renminbi would need to be a bit weaker, but then that would also call for lower equity markets than where we are right now. So there's some very interesting things that are being played around with in terms of the parameters that they're playing with.
That's essentially what your latest notes are saying as well, that this dollar movement can buy China a little bit more time in terms of equities as well. So what's your outlook for that?
I think it's a matter of time before this move actually happens, and really the question is really about the foreign exchange reserves. That seems to be absolutely crucial. So our numbers are indicating that maybe there may be an increase in the foreign exchange reserves for China of the order of magnitude of $100 billion. But now what is... Well, this is the question. Now we've had apparently the IMF asking the PBOC is to trying to explain what they've been doing in the derivatives market. And so we've seen the move in the renminbi overnight, supposedly as a reaction to that. So a lot of things going on, I think, and of course equities and other risk assets are just caught in the crossfire. Everybody's trying to figure out exactly what the big game is and how it's all going to play out.
Taking it to everyone's favourite country, you say here that Australian bank valuations look quite good at the moment. Can you explain a little bit more about that?
Can you explain yourself there? I mean, really, after what we saw out of ANZ today with these companies and bad debts, etc., and resource-laden companies with, well, debts which are not going to be paid back.
Yes, well, I could throw our analyst under the bus and say it was him who quoted it. I'm not going to do that. I'll take responsibility myself. I think
He just did, though.
I said I wouldn't do that. I think the thing is that on a relative basis, it looks better than some of the others. And if you look at the numbers that ANZ have announced today, I think it's about $100 million that they're talking about. I mean, there's been a report in the Financial Times, for example, that was talking about $150 billion that it potentially could be the cost of the whole oil and gas thing, which would put potentially European banks in a much bigger concern. We've actually been much more concerned about the Japanese banks with the negative interest rates, probably more concerned about the Indian banks as well from a trading perspective. But of course, at the moment, with the risk on flow, everything's gone up, and I think this is really the time where people need to put their trades on again.